So should we be concerned about retail investors going into the private markets? Isn't this just part of the democratization of the markets where retail investors have more access to these investments that were previously denied them? And why would it be bad to have more money go into those investments, either for the issuers or for the investments themselves?
Well, it's not a bad thing, of course. I mean, the more optionality retail investors have, the better it is for everybody. So no, there's no issue with it as far as access to the private markets. The challenge, Frank, is that it's not cheap, meaning that it's, first of all, it's mostly for accredited investors only until we go tokenized. And it's also not cheap. There's a lot of expenses that come with the private marketplace. It's different than the listed marketplace.
All right, so you're saying it's not cheap, but we are also talking about accredited investors. These are people that meet a certain threshold when it comes to income and hypothetically have a certain amount of sophistication when it comes to the markets. Why isn't it their responsibility to understand that? I was asking an earlier guest about quantum computing stocks. Those are pretty risky. They're a bit speculative. Everybody has access to those, and we don't worry if people are putting their money in those. Why are we so concerned about what are hypothetically more sophisticated people investing in these products?
Oh, no. Well, of course, because for quantum computing stocks that are publicly traded, the reason we're not worried about it from a risk reward or just from an opportunity side is because there's essentially no fees, no commissions. The stock is just what it is. It's a level playing field. The problem in the private marketplace, and again, there's nothing wrong with this, but the problem is that the secondary marketplace on the private side is usually controlled by different advisories, different brokerages, different advisories that package it up with, let's say, a 7% fee up front, and then usually a profit share on the back end of between 15 and 20%. So it's not like, hey, I'm buying a stock at $100, and if I sell it at 110, I make $10. It's like I'm buying a stock at $100, I'm actually only getting $93 invested, and if I make money on the trade, I have to give up 15 or 20% when I sell it, and I can't control the sale, meaning that some other fund or some other advisory controls the sale 6 months after the company goes public. So it's not exactly easy, and there's no secondary market. Also, you have to wait until there's a public event.
Yeah, but I mean, isn't this a big opportunity? By the way, we're showing a chart, I don't know if you can see it, of OpenAI over the last 3 years. Like 1,000% growth in the private markets. Then you have BlackRock coming out. And on all fairness, you know, it's like a shoe salesman selling you a shoe. They're saying the private markets are going to grow from $13 trillion in 2025 up to $20 trillion in 2030. Why wouldn't you just want to get in on that growth? Why wouldn't you want to get in there despite some of the fees and some of the other concerns? I mean, this is incredible growth.
I love it, and I think everybody should have the opportunity to get into that marketplace if you want. But again, Frank, you're talking about we're in a 15-year bull market, and bull markets make geniuses out of a lot of the private space. So you're looking at something where traditionally this has been a very risky place. In the last 10 years or so, there's been a lot of these stocks that have doubled, tripled. They've gone up 100. They've gone up not 100%, but let's say, a multiple of, let's say, 5 or 10 times whatever the initial investment is. I mean, I've traded a lot of these private placements, so I'm very familiar with them. I'm just saying, let's not get ahead of it. I think it should be open to the public. I think it should be available even to small investors. But I mean, I'm just saying, listen, just do it. Remember where we are.
Very quickly, Tom, let's talk about liquidity. Why do you think that's an issue when it comes to the retail investor, but not the institutional investor?
Well, the institutional investor has usually a longer time frame. For the retail investor, I don't think they're that used to, telling people that there's no liquidity is a little bit different for most retail investors. For most private investors, it's a little bit different on the institutional side. You're kind of expecting to be locked up for a certain period of time. For retail investor side, I think having no liquidity sometimes may scare people a little bit.
Do semi-liquid funds solve that? If we're looking at Deloitte stats, semi-liquid funds, 238 of them back in 2020. Last year, about 455. So does the idea of a semi-liquid fund, does that ease some of your concerns?
It does not, because the challenge with semi-liquid funds is exactly what it says. It's a semi-liquid fund in a very good market. Remember, if there was any kind of a turn in the market, that semi-liquid goes to virtually illiquid. Okay. So the funny thing is, Frank, I don't have any concerns about this. I really think that it's a great thing. I believe everybody should have access to it. In fact, like I said before, I hope this marketplace goes fully tokenized, and I hope small investors can get involved as well. But I think just be careful when you hear the broad statement of, the private markets are exploding with retail investment. It's a little bit different than you think.